Okay, so let's go ahead and get started. My name is Kathy Lien, and I'm Managing Director of FX Strategy for BK Asset Management. And I would like to welcome all of you to our monthly talk on FX Street. Today, we're going to focus more on fundamentals and talk a little bit about the most important event risk this week for not only the euro, but also the financial markets as a whole. As you should know, we've got the EU summit coming up, and the main question that's posed to us is, will the EU summit be another disappointment for the euro? And what we're going to attempt to do today is kind of talk a little bit about what Europe needs in order to fix herself, and then talk a little bit about what EU leaders will end up delivering at the EU summit. And we'll end with a little look at how this could impact the euro dollar, because it is not only the most important event risk this week, but it could also decide the fate of the euro dollar for weeks or months to come. Before I begin, however, please oblige me. I'm just going to run through this disclaimer with you really quickly because we have to. Past performance is not indicative of future results. Trading forex carries a high level of risk and may not be suitable for all investors. A high degree of leverage can work against you or for you. Before deciding to trade in any leverage products, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all risks associated with trading on margin and seek advice from an independent financial advisor if you have any doubts. The information, including commentary and trade ideas provided on bkforexadvisors.com and bkassetmanagement.com, should not be relied on as a substitute for independent research, which should be performed before making your investment decisions. BK Forex Advisors LLC and bkforexadvisors.com are merely providing this information for your general information. The information opinions presented do not take into account any particular individual's investment objectives, financial situation, or needs. All investors should obtain advice based on their unique situation before making any investment decision, or should tailor the trade size and leverage of their trading to their personal risk appetite. BK Forex Advisors LLC will not be responsible for any losses incurred in investments made by readers and clients as a result of any information contained on BK Forex Advisors LLC. BK Forex Advisors LLC does not render investment, legal, accounting, tax, or other professional advice. Investment, tax, legal, or other assistance is required. The services of a competent professional should be sought. So, with that, let's get into the meat of our presentation and talk a little bit about what to expect for the EU summit. So, there have been a lot of side meetings leading up to the major EU leaders summit at the end of this week. As you may know, we had the EU finance ministers, Eurozone finance ministers meeting last week. We also had a four-way meeting between the leader of Germany, France, Italy, and Spain. And all of that was aimed at hopefully coming up with a solution to finally end the Eurozone crisis. This is something that's crippled the markets and risk appetite for almost 2 years now, if not longer. And I think that Europeans getting a little tired of this, and it's become a situation where it's adding quite a bit of additional pressure on the markets. Because if you take a step back and you think about it, what's been happening in the world right now is kind of similar to what's been happening in the 2008 or what happened in the 2008 financial crisis, which means that at the end of the day, we know that Europe, the excesses of Europe, has caused a huge amount of debt burden for many of these countries. But it's really a crisis at the end of the day, a crisis of confidence, because the struggle that these European nations, particularly the distressed ones such as Spain, Portugal, Greece, and Ireland, are having is that they're being frozen out of the credit markets. Investors are deathly afraid that they're going to default on their loans, and they won't get, investors won't get their money back. So as a result, they are requiring a huge amount of yields to be willing to hold these European bonds. So, what I'm trying to get to is that yields are reaching levels like 7% or greater in some countries, where it has become pretty much, impossible for some of these nations to service their debt. So a way to look at this is just imagine, your finances as an individual are being pinched. And let's imagine that you're paying, you're used to paying 4% yield on, or 4% on any of the loans that you borrowed. And then suddenly, because no one really wants to lend to you anymore, but yet you still need money, that interest rate has gone from 4% to 7%. Now, for an individual, that may not seem to be much, but for a country who is borrowing billions of dollars and who has to service or make interest rate payments on a regular basis, these 1 percentage point differences, or in this case 3 percentage point differences, can make a huge difference on what they're able to do and what they're not able to do. And unfortunately, this ends up filtering down to the end consumer, because the only way for governments to raise money is to either increase taxes or lower their government spending, both of which pinches the economy even more. So it's kind of a really vicious cycle where this crisis of confidence is making it more and more difficult. And it's something that European leaders need to tackle head on. They need to sit at the table and basically try to come up with solutions to reverse the sentiment around, to end this crisis of confidence. So with that in mind, let's think about what will be discussed. Why is this meeting so important? I apologize for that. So let's discuss, let's think about what will be discussed and why this meeting is so important. Now, to begin, the reason why this meeting is so important is because there's a lot of expectations built up into this upcoming EU summit. The market is, based upon the recent price action, the Eurodollar, the market's hoping for a lot. They're hoping that finally EU leaders will get their act together and they will deliver the big announcement that is needed to end the crisis. And that's why we're seeing a little bit of stability in the Eurodollar. Investors can't help it. They put their faith in their policymakers, whether it's correct or not. And they hope that this faith in their policymakers will lead to some concrete results. So what needs to be discussed in this meeting, which all of the other European leaders will be pushing for outside of Germany, is what we call sovereign credit risk sharing. And what that means is that what you have to imagine is that all the nations in the Eurozone will share the risk of their neighbors. So, for example, if we have Greece defaulting on its loans, that Germany would assume the losses and make their payments. So that's what's known as sovereign credit risk sharing. But there's a lot of opposition to it, and as recently as this morning, German Chancellor Merkel pretty much said outright that she opposes any type of joint issuance of debt in the form of Eurobonds, which we'll discuss in a little bit, and I'll explain further in just a minute, and also any joint kind of deposit insurance. So she's basically opposing all of this, left and right, and that's posing a problem for the Eurozone, because without the Germans willing to lend their credit rating and to open up their pocketbooks, we can't make any progress. So let me kind of walk you through what the solution, what Europe really needs in order to turn things around, in order to fully end the crisis. So hopefully you can have a better understanding of these terms that are being used in the market. So what Europe needs to fix herself. What Europe needs is this sharing of sovereign credit risk, sharing of the burden for the distressed debt and the problems in the Eurozone. So how can this be done? One of the ways to effectively, kind of end this crisis is through something called Eurobonds. And what these Eurobonds are instead of each individual nation borrowing on their own, which is what's happening right now. We have Italian bond auctions, Spanish bond auctions, Greek, there's no Greek auctions, but, instead of these nations borrowing on their own, what would happen is that the Eurozone would end up borrowing together as one unit. Now, there are huge advantages to this, because the problem, as I outlined earlier, is that when Spain wants to borrow from the market, they're paying anywhere between 6 to 7%. And so, as this yield continues to grow, it becomes more and more of a burden for the Eurozone. So if we were to have Eurobonds, where instead of having these individual auctions, and we would only have, auctions of these Eurobonds, what would end up happening is that Greece and Germany would pay the same interest rate. Just think about that. Greece and Germany would pay the same interest rate that's in the Eurobond. So what does this mean? Well, this naturally means that Germany would be paying a higher interest rate and Greece would be paying a lower interest rate. For Greece, Portugal, and Ireland, and Spain, this is fantastic. This is wonderful news. For German taxpayers, this is awful news, because it means that, because of the problems of their neighbors, they are forced to pay, a higher interest rate on their loans or on their bonds. And, that really ends up coming from the pocketbook of the Germans. So as you can imagine, asking German taxpayers to assume more of their neighbors' problems is not sitting well with German Chancellor Merkel or with her constituents, which is why she so adamantly opposes the idea of Eurobonds, because it would not only increase the yield on German debt, but it would also mean that they would have to assume any type of loss in the other nations and ask German taxpayers to pay more. So this is a huge contention point, because Eurobonds is one of those few solutions for the crisis where Germany can wrap her AAA rating around the whole nation or around the whole Eurozone and provide kind of a shelter for everyone, and say, okay, they no longer need to deal with these 6 to 7%, or even in some cases 10 to 15% yield. They can actually borrow at levels that we borrow, which would probably be somewhere closer to 3 or 4%, if not lower. And so this would really bring a huge amount of relief to the region as a whole. But in order for this to happen, what Germany argues is that they would need a tighter fiscal union. And, I don't think, Germany certainly doesn't believe that that the other countries realize what it takes to form a fiscal union. A fiscal union, a great example of fiscal union, is simply the United States, where national governments would have to cede control on a fiscal and political basis, not all of it, just part of it, to one entire body. So in essence, they would be surrendering say in their budgets, so that money can be transferred from stronger nations over to weaker ones. Similar to the way things operate in the U.S., where richer U.S. nations would be forced to finance richer U.S. states would be forced to finance poorer U.S. states. To explain why why the Germans hate this idea, all you have to think about is imagine asking German taxpayers to have their tax revenue, basically, what they're shelling out on a, bi-weekly basis in their paychecks, basically having that money being transferred to Greece to fund their social welfare programs, to fund their, retirement insurance and things like that. So instead of the money sitting at home, which it really needs to in this current economic environment where everyone's just fighting for economic survival, this money needs to be transferred to, Greece so that they can pay for their social welfare programs. Just a mere thought of this is something that the Germans oppose significantly. So as you can imagine, this is why Eurobonds are so deeply unpopular. Now, German Chancellor Merkel is not completely opposed to the idea. She obviously says that she doesn't support the idea of Eurobonds, but she really doesn't support it in the short term. But she kind of says that, okay, maybe a solution in the long term. But, what she's really telling us is that she doesn't want this to happen under her watch. So this is a big reason why I believe that this week's EU Leaders Summit will prove to be another disappointment for the euro. Because, at the end of the day, the Germans refuse to accept the burden of higher interest rates, and also accept the burden of what's happening in the United States, which is that richer nations need to support poorer ones. And until the sentiment changes, and until the Germans soften their tone, I think that any type of rally in the Eurodollar would be looked at as an opportunity to sell at higher levels. And if anything, the Eurodollar will remain under pressure this week, as it has so far. So, as of this morning, Merkel has shown more opposition than kind of concession, and for that reason, that can kind of confirms that we shouldn't expect much from the EU Leader Summit. Even ECB member Nawatny came out this morning and tried to temper expectations, saying that we really shouldn't expect much because given the opposition of the Germans. Another thing that Europe needs to help end the crisis is something known as the jointly guaranteed deposit insurance. Now, to understand this, we have to understand what Europe has right now and what they want to have and what they need to have. Like in the U.S., there is kind of like a quote-unquote FDIC insurance, where if you put a certain amount of money in your bank, it's guaranteed. But the problem with the Eurozone is that right now they have 100,000 euros that are being guaranteed. So if I'm a Spanish citizen, 100,000 euros of my bank deposit is guaranteed by my bank, guaranteed by my government. And that is the main issue, which is that it's guaranteed by the government. And it is the government's fiscal finances that are really, at issue right now, because, these governments are teetering at the brink of default. And so if they are the ones, if Spain or Greece is the one guaranteeing my bank deposits, given the problems that they're having right now paying their loans to foreign governments, how can I be assured that my money is safe? So that is the issue. Because it's guaranteed by these individual governments, people do not believe that their money is safe. And so this is what we're seeing right now in this image. We're seeing these kind of little bank runs in Greece, little bank runs in Spain, where people are going into the banks on a regular basis, taking out their money in euros and putting it into German banks. So this is a problem, and it's a problem because it creates a liquidity issue for these local banks. And so if they have a liquidity issue, that's kind of a pretty big deal, because it could lead to the requirements of the government putting money into these banks and kind of saving them, which will require even more funds. So in order to prevent a run on the banks, which is really what the guaranteed deposit insurance is aimed at, what the Eurozone, what the world wants the Eurozone to do is to jointly guarantee these deposit insurance. To say that, okay, your 100,000 euros, for example, is not just guaranteed by the Spanish government or the Greek government, it's guaranteed by the entire Eurozone. So you don't need to be afraid, because the Germans will step up and guarantee your bonds, your bank deposits as well. And so the whole idea of that is to kind of reassure savers, to reassure bank depositors that their money is safe, and to prevent a bank run. So, just to summarize, what Europe needs is, number one, a shared sovereign credit risk in the form of Eurobonds, where the Eurobonds represents the bonds for all these countries, which would help to reduce the interest rate that these countries would have to pay, except for Germany, which would have to pay a higher interest rate. And it would also help to improve investor confidence by reducing the risk of their investments being lost because of the default of Greece or Spain or Ireland or Portugal. The deposit insurances are aimed at preventing a bank run. So there's kind of a two-pronged approach here that is needed to end the crisis. But what Europe needs is very different from what EU leaders are prepared to deliver. What are EU leaders prepared to deliver? Well, this is just so you know, this is a picture just from this past weekend of German Chancellor Merkel sitting and watching the German-Greek soccer game. And, obviously, that the Germans won, and this is her cheering, while the Greeks are, obviously not very happy with this. Just showing more muscle by the Germans versus the Greeks. So what will the EU leaders deliver come Friday? Well, one of the things that we heard from the kind of German camp this morning is, and also from the ECB, is that they're worried that the market is focusing too much on the debt burden sharing issue. What they would rather them focus on is what kind of is expected to be delivered, because what is needed, which is the debt sharing, is very different from what is going to be delivered. So with that in mind, these are the announcements that I expect to come out of the EU Leaders Summit. Now, these are still quite major announcements, and it's a step in the right direction, but unfortunately, it's going to fall short, because as I mentioned earlier, what the market is hoping for is a fiscal union and some type of debt sharing. But instead, what they will get is, number one, a $130 billion growth package. Now, this is important because the growth package is needed to kind of support the rest of the equation, I like to say, because one side of the problem is the debt. The other side of the problem is growth. So this $130 billion growth package is obviously aimed at the other side of the problem. So even if there is sort of an agreement at the end of the day that Germany is willing to assume the debt of its other countries, there still needs to be steps to spur growth, and this is what this package is aimed at. Now, this was first announced after the four-way summit last week between Germany, France, Italy, and Spain, but no details were provided. So at the end of this week, the communique or the statement from the EU Leaders Summit should outline the details of what this Euro $130 billion growth package will involve. So it is a pretty big announcement, but once again, it is not something that will change things around dramatically for the euro, because right now it's a credit risk that is the issue. The other announcement that will be made on Friday is a tax on financial transactions. Kind of like I don't know if some of you may have heard of the Tobin tax, where basically, tax on stocks and derivatives instruments and bond instruments. There'd be basically an added tax on any transactions of stocks, bonds, and derivatives. And this money would be then put into funds that would help to fund future bailouts. So this is a good thing because they're creating a larger next egg in the Eurozone. Now, this is something that will probably be only charged, for European or Europe-related transactions, because this is still something that the U.S. opposes on a global level, because the U.S. believes that a tax on financial transactions would hurt competitiveness in the financial sector. But, the Europeans believe that this problem is stemming from the financial sector, and so therefore the financial sector still needs to pay for it. So they're probably going to introduce a financial tax on transactions. They probably will end up having support across the region for this, except for maybe the UK, who also is such a huge supporter of it. But nonetheless, this will probably be the second announcement that we expect from EU leaders at the end of the week. The third announcement that we expect from EU leaders at the end of the week is a single banking supervisor. Probably coming from the ECB, who will kind of make sure that these banks remain healthy, make sure they don't fail any type of stress test, and make sure that there isn't any type of excess risk-taking in these banks. So having a single banking supervisor across the region would hopefully create uniformity that would help to stabilize confidence in the banks. And, this is something that's needed in order to implement any type of deposit insurance, if that's to be the case. So what these three things provide to us, basically the growth package, the financial transaction tax, and the single banking supervisor are quick wins. That's what it seems like the Europeans are going for right now. They're going for quick wins that will hopefully, bring some stability in the market and hopefully boost consumer confidence. And these quick wins can be done without requiring a change in the EU treaty, which is really the problem right now, because Germany is arguing that everything else will require a change in the EU treaty, whereas these little quick wins, the growth package, the tax, and the single banking supervisor, may not. So with that in mind, let's take a look at how this could impact the euro-dollar. Well, this is a slightly older, chart that I took a screenshot of. The euro-dollar right now, as you all know, if you're looking at the price action, is much weaker. It's trading around 124.80. All of the major currency pairs have sold off against the U.S. dollar, which tells us that investors are nervous going into the EU leader summit, and they're rightly skeptical because, as I've outlined, throughout this presentation, what EU leaders will probably deliver is very different from what the market wants and what Europe needs, and this is confirmed by the comments that we've had from German Chancellor Merkel this morning. So, with this in mind, the levels to watch in the euro-dollar is 27.4750 on the top side, as well as 22.88 on the downside. These are the major ranges for the euro-dollar, and I believe that, given what we've been hearing from the ECB as well as from German Chancellor Merkel, the EU summit could determine, which side of this range the euro-dollar will break. And in my opinion, if EU leaders disappoint and only deliver the growth package as well as the Tobin tax and the supervisory authority, that the euro-dollar will make a run for its year-to-date low at around 122.88. That's pretty much what we're looking at right now. I will expect the euro-dollar to remain under pressure going into the EU summit unless we hear any type of concessions from the Germans, but I don't think that's going to be the case, especially since we've heard so far more opposition than anything else. And if anything, the dollar and safe haven currencies will remain in demand for most of the week. So with that, if you bear with me for 1 second, I just want to show you something, and then I'll open up the floor to questions. So I'm going to shut off my camera for a second, and then I'll refresh my camera. Actually, before I do that, let me just show you the final slide, which is that if the Europeans disappoint in the EU Leader Summit, then it will really be just up to the ECB to rescue the market. The ECB will be meeting in July, and if the markets are disappointed by the outcome of the EU Leader Summit, which I expect them to be, then what we would anticipate is that the ECB would have to ease monetary policy come July. And that could come in the form of another LTRO operation, or it could come in the form of lower interest rates. So just give me 1 second. So if you'll bear with me for 1 second, I just want to kind of introduce you to our brand new website, bkassetmanagement.com, where we do write about a lot of this. Where we do write about, a lot of these issues. This is the new home for the content that both myself and Boris write. So in the top navigation bar, I wrote about the comments that German Chancellor Merkel made earlier this morning. You can see that in the first one, where it says Merkel crushes the EU summit hopes. And then I have a much more detailed outlook for the EU summit here. Will EU leaders successfully repair Europe? And we also touched on the solutions that the ECB could provide to rescue the markets in the form of LTRO as well as the interest rate cut. So if you're not familiar with what LTRO is, I encourage you to read, our our articles on LTRO. We also have a nice little video that we put together explaining to you what LTRO is. And if you look in our regular education section, you'll see we explained what quantitative easing is through a video. We've also explained what operation twist is. So, for those of you that are looking to learn a little bit more in fundamentals, I encourage you to read these and watch these videos. And if you want to receive our research via email, I encourage you to just kind of drop your name and email address here, so you'll be the first to receive the information when it comes and receive our research as soon as we deliver them. So with that, I would like to open up the floor to any questions that you may have. I have one question here already. It says, do you think a quick fix for the euro would be to expel the pigs? Well, I do not think that would be a quick fix for the euro, because if the Eurozone were to kick out Greece or to kick out Spain, for example, there would initially be quite a bit of volatility in markets and, probably quite a deep sell-off, which, would cause a great deal of risk aversion, probably force central banks to come in to and add a tremendous amount of liquidity in the markets and basically put everyone in panic mode. It is a possible long-term solution, but in the short term, it cannot be a quick fix because it would probably cause more anxiety than stability. So it should be in line with the demand there. I'm not too sure what the question is on this front, Soros, but if you would like, you can kind of try to ask the question again, and I'll be more than happy to answer it. Any other questions about how to interpret the EU summit, what to make of it, or anything you would like to ask about what to anticipate for the Forex market in the week ahead? Okay, so if there are no additional questions, I'll just kind of wrap up this session early. And once again, I encourage you all to visit bkassetmanagement.com. Okay, so here's a question here. How do you see cable this week? Very good question. I actually think that the British pound will remain under pressure this week, and I'm bearish the pound like I'm bearish the euro, because if we can anticipate that if we think that the EU leader summit will not yield anything and will end up being more of a disappointment, then we can only anticipate that the pressure will be on in the global economy. And the Bank of England earlier this month indicated that they're ready to ease again. So any sort of additional strain in the markets will only boost the case for additional quantitative easing from the Bank of England. So if anything, I am just as equally bearish pounds as I am euros. Do you feel the euro can be saved? The euro can be saved if Germany is willing to announce Eurobonds, but I don't necessarily think that it is something that they will agree to easily, if at all. The only solution for euro is a fiscal union. So if Germany won't agree with Merkel, then it continues on. Yes, that's exactly what I think, Em. Will Boons point the direction of the currency market reaction to this meeting? No, well, bonds. Yes, in some ways, yes. In some ways, no. It depends which bonds you're looking at. German bonds won't, but if you're talking about Spanish bonds and Italian bonds, I do believe that the bond yields will are a good leading indicator of market sentiment and what people expect going into the EU summit. Very good question. Where can we see the live bond charts? Bloomberg.com offers some nice bond charts, and I don't think they're live, and I don't think they include Spanish bonds and things like that, but it's a place to start. Last question. Would you say to keep away from the euro pairs? I actually don't necessarily think so, Boyke. I think that there are some downside opportunities in the euro dollar, and if anything, I would stay out of the euro come Friday, but I think that between Monday and Wednesday, and maybe even on Thursday, there's some opportunities in the euro dollar, in my opinion, on the downside. Do you think German bonds are no longer safe haven, given Germany may foot the bill for the euro? I think that, Jazz, for the time being, German bonds will still be looked at as a safe haven for Europeans, who may not want to move their money out of Europe. So they would only be a risk if the Germans acquiesce and agree to assume the risk of other nations. So I think the answer is really, in the short term, I think they can still be considered safe haven. In the long term, probably not. Do you think we will return to gold anytime soon? No, I think that's kind of a nuclear kind of event, Mo, and I don't think that that's something that I anticipate anytime soon. Okay, so if there are no additional questions, I would thank you so much for joining me, and I hope you enjoyed this fundamental focus session. We talk about a lot of things month to month. Sometimes it's technical, sometimes it's trading strategy, sometimes it's fundamentals. I think it's important to understand all of it, so hopefully you enjoyed the session. And as I said, you can always watch, kind of follow up what we've got on bkassetmanagement.com. We've got this really, if you click on the videos, you can watch all the videos on our recent takes on the currency market. Thank you so much, and I will see you next month.